You see that 7 or 8% yield shining on the screen. It looks like the shortest path to financial freedom, but it's not a loyalty bonus. It is, in fact, a silent mathematical trap. The plan here isn't just to collect monthly checks, but to ensure that your net worth isn't melting underneath them. The secret lies in what's called total return, and most retail investors ignore this metric. Large institutions like BlackRock in their reports don't just look at the cash coming in. They monitor the destruction of value behind excessive dividends. As Cliff Asness highlighted, focusing solely on dividends can distort the perception of return if you ignore the impact on the asset's price. Think about the telecommunications giants that dominate the American market, the ones that beginners' guides always put at the top of the list. Over the past decade, companies like AT&T and Verizon have maintained high dividends, often above 5%, values that far exceed the average of S&P 500 companies, while the main index hovers around 1.3% recently, according to S&P Dow Jones indices. In other words, they deliver 5 or 6 times the yield. But that isolated number hides the reality. Both operate in a low-growth, high-debt sector, which limits total return over time. And the results show this. Even with high dividends, they often lagged behind the market. And there's another detail that almost no one mentions. At the exact moment of the ex-dividend date, the stock price adjusts downward, according to an SEC bulletin. If the company pays out $1, the stock tends to open worth $1 less. It's not wealth creation, but a redistribution of your own capital. It's like taking money from your left pocket and putting it in your right. Even among them, the difference is revealing. In a recent period, AT&T delivered a total return significantly higher than Verizon's, showing that a high dividend by itself does not guarantee good performance. The first time I received a high dividend, I thought I had made money. It was only after looking at the chart the next day that I realized the stock price had adjusted by almost the same amount, except along the way, the government is waiting to take a slice. In the United States, if the dividend is not considered qualified, that is, if you didn't hold the stock for a minimum period, taxation takes a bite out of your gain as if it were ordinary income. It can reach about 1/5 of the total value, depending on your bracket. Even for long-term gains, the 15% rate is common, according to IRS Publication 550. This means you pay tax on money that was already yours. Now, look at the actual numbers over an entire decade. While the overall stock market tripled in value during that period, the biggest dividend payers in the telephone sector stagnated. One of them delivered only about 1/10 of the market's return. The other barely reached 1/15 of the overall performance. This happens because they are capital-intensive, massively indebted sectors. This pattern resembles what happened to railroad companies in the 19th century after railway mania, where high payouts to shareholders masked the structural deterioration of the businesses, companies that need to spend billions just to keep the towers standing. There is no room left for innovation or real market growth. Unlike names like Apple or Microsoft, they don't distribute all the profit they generate to shareholders, but reinvest most of it in research and new products. The result? The stock price soars over the years, and the dividend, although it seems small today, grows on a giant base. Many critics call this the irrelevance of dividends. The idea goes back to the 1961 paper by Merton Miller and Franco Modigliani, who argued that dividends, by themselves, do not create value in efficient markets. They say you could simply sell a fraction of the stock and have the same effect. But there is a human factor that pure mathematics does not explain. The constant cash flow helps maintain emotional discipline. In 2020, during the market downturn, a colleague only managed to hold some positions because they kept paying dividends. It wasn't rational, it was psychological. It's much easier to hold a stock during a decline if it pays you to do so. The dividend acts as a shock absorber in bear markets. That's why the smart strategy doesn't focus on one extreme or the other, but seeks a balance between appreciation and passive income. Use assets like the SCHD ETF to focus on sustainability, or VOO, to ensure you keep up with the growth of the world's largest companies. The true engine of wealth is automatic reinvestment, the DIRIP. Every cent that returns to the broker should buy more pieces of the business. This accelerates the effect of compound interest exponentially. In about a decade and a half, the number of shares can double without new contributions. As in the logic of exponential growth studied by Albert Einstein, reinvestment doesn't impress at the start, but it completely dominates the outcome in the long run. Avoid sectors that are just buying the investor with a high yield. This is often a sign that the main business has lost momentum. Always analyze the payout ratio, the percentage of earnings that is distributed. If the company delivers almost everything it earns, it has no way to grow. If it goes into debt to pay shareholders, disaster is imminent. The ultimate goal is to build a portfolio that is a fortress, that produces income without you having to sell your positions. But that also doesn't leave you behind in the race against inflation. Real wealth doesn't come from the highest yield today, but from the greatest accumulated wealth at the end of the journey. Keep your eyes on total return and your feet on the ground. Time is your greatest ally, as long as the math is on your side. Work with the market, not against the laws of economics. Ignoring total return is almost a cognitive bias, something Daniel Kahneman described when showing how we tend to value visible flows and ignore less obvious losses. That's how you build a financial legacy that truly lasts. If you've made it this far, you already understand tax efficiency better than most. But theory is only half the way to the top. The other half is execution and constant monitoring. I want to hear from you in the comments. Which of these giants have you crossed off your list after seeing the real data? Or do you still believe a high yield offsets the risk of a drawdown? Your input helps shape our upcoming technical deep dives. If this content brought clarity to your strategy today, consider following our future case studies here on the channel. Hit the subscribe button and turn on notifications. This ensures you receive our reports as soon as they drop. Straight to the point, with an exclusive focus on data integrity. Thank you for investing your time in our work. We'll see you in the next video with more substance and fewer distractions. Until then, stay focused on what truly matters, your total return.